Most people grow up believing one simple rule: money is power. We're told to study hard, earn a salary, save cash, and climb the ladder of wealth. But history whispers something different, a hidden truth lived by emperors, industrial titans, and modern financial institutions. Imagine you're holding a stack of dollar bills. Now picture someone holding the deed to an entire city block. You have cash, they have an asset. Now ask yourself, if nations print money, but banks own the factories, the real estate, the shares, the supply chains, and even the debt itself, who really holds the steering wheel of history? This isn't a story about earning more, it's a story about owning more. Let's go back through time, peel history layer by layer, and discover how the throne of power quietly slipped from currency into ownership. In the 1500s, power was tied to crowns and conquests. Monarchs ruled because they owned land by default: farmland, castles, ports, cities, nations. Wealth was visible, physical, and personal. In Europe during this era, land wasn't just soil, it was identity, economy, strength, legacy, shelter, and political leverage. But after the 1600s, merchants began to understand something ingenious. You don't need to rule the land if you own the trade running through it, or the debt placed on it. Instead of fighting kings directly, they created companies. Instead of conquering the world militarily, they conquered it through ownership of routes, goods, and collateral. This gave rise to the first mega-asset empire: ports and sea routes, spices, silver, tea, cotton, colonial infrastructure, and most importantly, asset-backed financing. One defining organization later crystallized this era: East India Trading Syndicate, which didn't need a crown, it needed ownership papers. The public, by contrast, held coins that lost value season by season due to wars, metals, shortage, and limited minting capacity. Meanwhile, banks began holding land as collateral. Merchant fleets, tax-farmed territories, equity stakes, key shift unlocked. Kings ruled people. Banks began owning nations' assets via debt leverage by late 1700s. Land ownership was quietly mortgaged, supplied, financed, collateralized, and no longer personal. It became balance sheet power. Then came the Industrial Revolution, a fire that changed the world faster than any war. But the real miracle wasn't steam engines or railroads, it was who ended up owning them. Here is what the Industrial Age introduced to the power equation. New asset classes created. 1. Coal mines. 2. Steel factories. 3. Railway infrastructure. 4. Manufacturing plants. 5. Electricity production. 6. Mass workforce deployment. 7. Corporate ownership backed by finance. A key financier of these industrial expansions was J.P. Morgan. His genius. He didn't build the machinery, he financed the companies, bought ownership stake, and consolidated assets so aggressively that industries and banks became inseparable. On one side, the public was working to earn wages, spend currency, rent land, buy goods. On the other side, banks funded industries too, owned shares, owned factories, mortgaged railroads, collateralized industrial assets. Henry, for instance, built cars as assets, but banks financed the factories and acquired shares through leverage. History's clear verdict: builders create assets, banks finance them, institutions own them. By 1900, power networks looked like this: public equals workers, spenders, renters. Banks equals owners of industrial assets via lending, and consolidation. Currency became smaller, ownership became bigger. Nearly every economic textbook romanticizes gold as the original economic power source, and yes, for centuries it was. But by early 1900s, something deeper began forming: gold-backed currency. But assets-backed loans became stronger. This was the age where central banks controlled money printing, but private finance and institutions controlled the asset ecosystem built around the printed money. One place became the ownership war arena: Wall Street blocked by 1933. Asset logic had changed. Central banks stored gold. Private institutions financed industries. Banks held collateral rights to assets built through loans. Corporations issued stocks as nation-level assets. Citizens saved currency that lost value to inflation. Institutions bought real estate that gained value through inflation. One vault that symbolizes institutional ownership, Bank of England vault. Gold stayed important, but ownership of gold plus land plus corporate equity became an institutional game, not a public one. Major shift. Conclusion: before 1900 gives gold standard, after 1900 gives asset ownership standard. By 1971, gold stopped backing the dollar, not assets. This event marks the final nail in the myth that currency is king. Most people think oil created global dollar dominance, but the deeper truth is, greater than oil was the asset. The dollar was only the medium to trade it. Governments produced oil. Banks financed extraction. Institutions acquired ownership risk without producing a single drop. Corporations like Exxon oil fields, Shell energy networks, BP asset holdings, banks financed them. Institutions owned shares in them afterward. Trade deals happened in dollars, but ownership happened in equities. By the 1990s, asset power included oil equity, global stock ownership, real estate leverage, commodity portfolios, one trading message platform, later reflecting retail asset trading. Robinhood markets, citizens could trade assets, but institutions owned the companies, price leverage, and debt behind them. From 2000 onwards, asset power became digital, global, silent, and more systematic than any empire ruled by swords. Strongest assets today. 1. Real estate mortgages turned public buyers into renters of ownership until payments close. Meanwhile, banks used mortgage debt to stack more real estate assets via securities. One modern asset giant symbol, BlackRock Portfolio Systems. 2. Equity shares. Owning shares became wealth. Holding currency lost wealth through inflation. Primary markets like New York Stock Exchange. 3. Government debt as an asset. Governments print bonds. Banks buy them. Institutions hold them as assets. Public pays inflation cost. A key organization guaranteeing bank confidence. FDIC. 4. Commodities, gold, oil, copper, lithium, land, grain, water rights, but owned by portfolios, not households. 5. Algorithmic market ownership, pricing, trades, hedging, equities, risk evaluation, inflation modeling, all automated by institutional algorithms long before the public sees headlines. Public works to earn gives cash. Banks lend cash to public gives assets. Public pays interest gives banks profit. Asset prices rise from inflation gives institutions profit. Public currency loses inflation value gives public loses. The paradox equation. You own the currency, banks and institutions own the assets. This era was not built to keep you poor. It was built to keep you busy renting, not owning. So remember this. Greater than money is spendable. Assets are ownable. Debt is scalable. Ownership is inheritable. Inflation hurts cash holders. Inflation enriches asset owners. If power was still tied to currency printing, humans would rule it. But now that power is tied to institutional asset ownership and debt leverage. The throne has already moved. Ask yourself, are you earning money or building ownership? Because history proves ownership wins.